So these are questions fully extracted from the financial services and payment systems, and it carries a total of 100 marks. So in your attempt, we will be analyzing various subtopics of this unit. So I'll be reading out the question very quickly because the questions are procedural. So Vero and Tana incorporate VetaPay Limited, an online platform through which customers deposit money, maintain digital wallets, transfer funds to merchants, and withdraw money through agents. VetaPay commences operations before obtaining approval from the CBK, arguing that it is merely a technology company. After receiving a warning from CBK, VetaPay submits an application containing only its certificate of incorporation and a two-page business proposal. It does not disclose its beneficial owners, capital, trustees, settlement arrangements, agents, outsourcing arrangements, cybersecurity controls, or anti-money laundering systems. VetaPay deposits customer money in its operating account and uses part of it to pay salary and rent. It launches a digital credit product and lends part of the customer money to borrowers. It appoints 500 agents without notifying CBK or conducting suitability assessments. You are supposed to advise Vero, Tana, and VetaPay the following: whether VetaPay requires authorization and the proper application process, the legal requirements governing capital, governance, and safeguarding of customers' funds, and the legality of its lending activities and appointment of agents, including the possible regulatory consequences. I repeat the question so that you clearly understand what you are answering. You have been told there is Vero and Tana who have decided to incorporate VetaPay Limited, and it's an online platform through which customers deposit money. They can even maintain digital wallets, and there are some transfers and even withdrawals. But VetaPay commences operation before obtaining approval from the CBK, arguing that it is a mere technology company. And they even receive a warning from CBK. And VetaPay submits an application containing only its certificate of incorporation and a two-page business proposal. It never discloses other details. Now, VetaPay deposits customer money in its operating account and uses part of it to pay salaries and rent. It launches a digital credit product and lends part of the customer money to borrowers, and even appoints 500 agents without notifying CBK. Now, from your knowledge of financial payment system, can you advise Vera and Tana and VetaPay on whether VetaPay requires authorization and the proper application procedure? Then, what are the legal requirements governing capital, governance, and safeguarding of customers' funds? Because this one, in this situation, you have seen it is being used in the operations account. Then, what is the legality of its lending activities and appointment of agents, including the possible regulatory consequences? So, quickly try out the question because you have been taught on financial payment systems. Any attempt? We said these questions will be invoking your gap in financial system because there is a separate webinar where we'll have to revisit the whole unit so that students usually understands very basics of the unit. So in my assessment, that question is difficult for you to attempt because you have not come across various regulations that the unit is requiring from you. So authorization and application. So VetaPay is not merely a technology company because it receives customer money, it stores monetary value and transfers value to merchants and facilitates withdrawals. So these activities constitute payment services, and to the extent that the wallet value represents a claim against VetaPay issued upon receipt of Kenya shillings and accepted by third parties, the value constitutes e-money within the meaning of Regulation Number 2 of the National Payment Systems Regulation of 2014. So this question was merely asking you, have you read the National Payment Systems Regulation of 2014? And what do you consider for you to call a certain entity a payment service provider? Under Section 12(1) of the National Payment System Act, a person must not conduct the business of a payment service provider in Kenya unless authorized by CBK. In addition, Regulation 4(1) requires a person, other than an institution as defined in the Act, to apply for authorization before commencing business. VetaPay therefore acted unlawfully by commencing operations without authorization, and the application must be made in Form 1 under Regulations 4(2) and 5(2) and must be accompanied by non-refundable application fee prescribed in the first schedule. Under Regulation 6, VetaPay must first submit 3 proposed company names to CBK in order of preference. They reserve the approved name with the registrar of companies and refrain from using the name for payment service business until authorization is granted. A new product name similarly requires approval under Regulation 7. And VetaPay's application is materially incomplete because we are told that they attempted to do an application. Under Regulation 4(2), it should provide its incorporation documents, the service and program of operations, the public interest served, a 3-year business plan and indicative budget, proof of prescribed initial capital, governance, internal control, risk management, and accounting requirements. We also have anti-money laundering controls, its organizational structure, agents, branches, and outsourcing arrangements, settling arrangements, particulars and fit and proper forms for directors, managers, trustee, and significant shareholders, its head office address, customer, agent, cash merchant terms, a tax compliance certificate, and a credit reference report, and any further information required by CBK. So this is to tell you that VetaPay's application did not submit other documentation that it is required under Regulation 4(2) of the National Payment Regulations of 2014. Under Regulation 5(3), CBK may request additional information within 30 days if the application is incomplete or further information is necessary. CBK must assess the matters listed in Regulation 5(4), including VetaPay's capacity to provide services safely and efficiently, the effect of its other business activity, the integrity or significant shareholders and managers, the suitability of trustees, and the required core capital. If satisfied, CBK advises the applicant to pay the authorization fee and issues the certificate within 7 days of payment under Regulation 5 all the way to 6. If it rejects the application, it must communicate its reasons within 7 days under Regulation 5(7). That is why VetaPay will require authorization, and the procedure for application and even the form number 1 to use is listed in Regulation 4 and 5 of the National Payment System Regulations of 2014, and that's read together with Section 12(1) of the National Payment System Act. So I tested your ability to master the procedure for seeking authorization from the CBK, and that proved a challenge. The second question, I also tested on what is the legal requirement governing capital governance and safeguarding of customers' funds, because we have been told that if customer funds are being used to run the operations of the company. Under Regulations 11(1), a payment service provider must hold the prescribed core capital both at authorization and all times thereafter. The first schedule prescribes core capital of Kenya shillings 5 million for an electronic retail payment service provider, Kenya shillings 20 million for an e-money issuer, and Kenya shillings 1 million for a small e-money issuer. So it is important for you to understand that category. If you go straight to Regulation 11(1), you are told that there is a prescribed core capital amount required both at authorization and at all times thereafter, after you have been granted this authorization. In the first schedule of this regulation, we are told that 5 million will be applicable for an electronic retail payment service provider, and 20 million will be for an e-money issuer and 1 million for a small e-money issuer. So the appropriate category depends on VetaPay's approved business model that will be approved by the CBK. Under Regulation 25, VetaPay must establish effective, transparent, and adequate governance arrangements. These include a suitable board of trustees, documented ownership and management structures, segregation of duties, internal controls against fraud and mismanagement, and separation of payment services into a distinct business unit with separate management and books of accounts. Most importantly, Regulation 25 requires VetaPay to establish a trust, place all money received into the trust fund, ensure that the trust balance is never lower than the amount owed to customers, refrain from transferring the money to its ordinary operating account, and avoid commingling customer funds with other funds. The trust money must be diversified and placed in licensed commercial banks or Government of Kenya securities. The applicable diversification limits are prescribed by Regulation 25 and the 4th Schedule. So the trust deed must contain the matters listed in Regulation 26, including how the fund will be held and invested, appointment and duties of trustees, termination arrangements, dormant and deceased persons' accounts, beneficiary rights and dispute resolution procedures. Any proposed amendment requires prior CBK approval under Regulation 26(2). On YouTube, there is a video of a former retired deputy director of the CBK who operated in 1980s. It is an NTV video. And one of the fraud that happens during the one of the fraud that happens in the banking sector, that the deputy director tried as much as possible to fight, but corruption agents fought her back to the extent that she lost the job, and she first had received a warning. It is when deceased persons have left a bank account with money, and if the beneficiaries does not understand that there was a such bank account, there are some shoddy dealings that happens in that sector, and even some people lose their life when trying to execute something to do with that procedure. And it is a chain that is even evolving across. It's a chain of professionals that are required in that sector, and it's a very murky world. So by depositing customer money in its operating account and using it for rent and salaries, VetaPay breaches Regulation 25, 3B to E. It must immediately restore the trust fund and separate customer funds from its own property. So the principle also applies to advocate's account. So you just know when you're dealing with a capital and you have been approved as a certain business model pursuant to the CBK authorization procedure, then you will never mix customers' funds. Instead, you will be opening a trust fund where these funds will be deposited. The other question I asked you on the legality of its lending activities and appointment of agents, including the possible regulatory consequences. Now, we have been told that the business decided to employ 500 agents without disclosing to the CBK. It is even engaging in lending activities without seeking approval from the CBK. What is the consequence that the company is likely to suffer? So VetaPay's use of customer funds for lending is unlawful. Under Regulation 45, an e-money issuer other than an institution must not engage in lending or investment activity except as required by the regulations. Lending may also constitute digital credit business, requiring separate licensing under Section 33S of the Commercial Bank of Kenya Act, unless VetaPay pays within a statutory exception. Payment service authorization does not amount to a lending license. Okay? VetaPay may appoint agents under Regulation 14, but it remains liable to customers for acts performed by agents within the scope of the agency agreement under Regulation 14.4. The agreement cannot exclude that liability by virtue of Regulation 14.5. Before enlisting agents, VetaPay must notify CBK at least 14 days before commencement under Regulation 16 and submit the information listed in Regulation 16, including recruitment procedures, the proposed agreement, anti-money laundering policies, technology, risk assessment, security assessments, and training materials. Each agent must satisfy Regulation 17, while VetaPay must maintain records, train and supervise agents under Regulation 19, and exercise due diligence and assess suitability under Regulation 20. So the breach attracts a requirement to remedy the violation under Regulation 56, a general monetary penalty penalty fee of 1 million, where no specific penalty applies under Regulation 57. Remedial action under Regulation 51 and yes, so apologies. So the other breach that the company is also likely to suffer is a million penalty fee. They have the remedial action under Regulation 51 and suspension of revocation under Regulation 10, because Regulation 10 specifically permits action for unauthorized activities, failure to manage agents, failure to safeguard the trust fund, anti-money laundering breaches, and compromising public trust. So we can say that the regulations are also allowing various remedial actions to be taken, and failure to do that can lead to suspension and even a penalty fee of 1 million. So the regulations can be said to be friendly in that it is allowing you to do some steps. The other part of the question is a brief one and direct to the point, and it is extracted from licensing, suitability, and renewal. And you are told directly that Jirani Payments Limited wishes to produce electronic retail transfers. Its proposed managing director was convicted of fraud 10 years ago. One significant shareholder is an undischarged bankrupt. Jirani intends to rely on an authorization that expires in 3 weeks but has not applied for renewal. So, this question now tells you we have a person who has applied for renewal, for authorization, but he has not applied for renewal. What is the repercussion that is most likely to be incurred to this individual or company? And question A tells you, explain CBK's procedure and criteria for assessing the suitability of Jirani's controllers and managers. And B, advise Jirani on the applicable initial capital, application fee, and authorization fee, and explain the procedure and timeline for renewing its authorization and the consequences of continuing after expiry. So my key goal is to identify what is the procedure for renewal of an authorization from the CBK, because we now know the procedure for applying for authorization and being categorized in a certain business model. Now, is any one of you knowing the procedure for renewing an authorization and consequences of continuing after expiry of that authorization has lapsed? Okay, so for understanding purposes, I'll straightly jump into part C, then we'll answer the other questions. Under Regulation 9 of the National Payment System Regulation of 2014, an application for renewal must be submitted at least 2 months before expiry. It must be made in Form 2. It should contain any information required by CBK and be accompanied by the annual renewal fee prescribed in Table B of the first schedule. The fee depends on the provider's annual gross transaction value. Jirani is already late because its authorization expires in 3 weeks. It should immediately approach CBK, make a complete application, and seek regulatory directions. It should not assume that a late application automatically extends the existing authorization. If the authorization expires without renewal, Jirani must cease regulated payment services, because Section 12 of the National Payment System Act and Regulation 4 prohibit unauthorized operation. Continued operation may attract a remedial direction under Regulation 56, penalties under Regulation 57, and prohibition from offering payment services under Regulation 51 1A. So those are the consequences that the company is likely to suffer. Then you are told to describe how CBK will assess suitability of approved trustees and significant shareholders. So CBK must assess and approve trustees, significant shareholders, directors, and senior managers under Regulation 8. Where the trustee is a corporate entity, its directors, senior management are also assessed under Regulation 8. The criteria is contained in the second schedule pursuant to Regulation 8. CBK considers professional qualifications and experience, probity, competence, soundness of judgment, reputation, honesty, and even integrity. It also considers convictions involving fraud, dishonesty, or violence, deceitful or oppressive business practices, contraventions of laws protecting the public and against financial laws, regulatory investigations or disciplinary action, unpaid judgment debts, insolvency, and even bankruptcy. So the fraud, conviction, and discharge bankruptcy are therefore directly relevant and may lead to CBK to find the proposed persons unsuitable. Their interest must be fully disclosed in the fit and proper forms. Concealing the matters will itself undermine their application and may later justify revocation under Regulation 10 for authorization obtained through false, misleading, or concealed information. So this now marries to the first question that we discussed, where we saw a company trying to hide its board of trustees. So we are told that CBK will find a way to assess the same. They will look at your convictions and whether you are publicly fit for holding public money. Then, on fees and capital, Jirani seeks authorization as an electronic retail payment service provider. Under Registration 11 and Table A of the first schedule, it must maintain a core capital of 5 million at authorization and at all times thereafter. Under Regulation 5 and Table A, the non-refundable application fee is Kenya shillings 5,000. If CBK approves the application, the authorization fee is 100,000 and the CBK will issue the authorization certificate within 7 days after receipt of that fee under Regulation 5. So I want you to appreciate how the marking scheme is detailed, and it is full of regulatory compliances because it is directly from the regulations and the Act itself. And this is in purpose because the commercial transaction unit haitaki a lot of stories. Inataka tu, do you know this procedure? Where is it provided for? And if you even don't know where it is provided for, can you clearly identify this is what happens in such situations? So question 3 is testing on agents, outsourcing, and regulatory responsibility. This will be the last question. Then we go to extradition procedure, where we'll analyze the extradition procedures in 2 facets, and even the third facet involving ICC red notice, where you receive a notice from ICC. What will the country have to do? So on agents outsourcing, let me confirm whether there is a more detailed procedure that is more frequent. Electronic transfers. Remember, this unit, financial payment system, is also having a link between data protection. Okay, good. Let us do designation, interoperability, and access. The reason why I chose this is because it has featured a lot in many past papers that we have come across, so we can't escape this designation question. And you are told that Kenya Retail Switch Limited operates a network processing most online retail payments in Kenya. CBK considers the system nationally important and directs it to apply for designation, and the company refuses. It later excludes a small payment provider from membership without applying transparent rules and introduces a new payment channel without CBK approval. So in brief, we are told that there is a company that is operating a network processing most online retail payments in Kenya, and therefore CBK considers the system nationally important and directs it to apply for designation. Now, the examiner expects you to explain the procedure and requirements for designation. Look at how the questions are deliberate. Do you know the procedure for authorization? Do you know the procedure for renewal of the authorization? Do you know the consequences of operating if the authorization has expired? That's a separate thing. That's for payment services. Okay? But do you know understand the procedure and requirements for designation? Okay? Advice on interoperability, membership, and fair access. Explain the legal requirements applicable to the new payment channel and the possible consequences of non-payment. Now, designation. Under Regulation 52, CBK determines whether a payment system or payment instrument qualifies for designation under the NPS Act. And once notified, the operator must apply under Regulation 52(2), and the application must be in Form 1 and accompanied by the prescribed non-refundable fee under Regulation 52. Under Regulation 52(4), Kenya Retail Switch must provide projected financial statements where it is a new operator, its organizational and governance structure, and documents addressing participants' rights and liabilities, payment flow and settlement, prudent fund management, safety and operational reliability, contingency arrangements, fees, and outsourcing. An existing operator must also provide the value and volume of transactions for the preceding 6 months. Under Regulation 53(1), CBK designates a payment system or instrument by Gazette notice. CBK then ensures compliance with the Act and designation conditions under Regulation 53(2). So under interoperability and access, under Regulation 21, payment providers must use systems capable of becoming interoperable domestically and internationally. They may enter interoperability arrangements under Regulation 21. Where a payment service provider management body is used, it must provide CBK with clear, fair, and non-discriminatory access procedures and adequate membership and risk management rules under Regulation 22. Its rules may regulate admission and, with CBK approval, termination of membership under Regulation 22(4). Excluding the smaller provider without applying fair and transparent rules may breach Regulation 22 and justify CBK's intervention. We are also told that they have introduced a new channel that they have not made it clear to the CBK for approval. Under Regulation 54, an operator intending to introduce a substantial change or enhancement to a designated payment system or instrument must seek CBK approval at least 30 days before implementation. Additional functionality through a new electronic channel is expressly recognized as a substantial change by Regulation 54, and failure to seek approval may lead to corrective measures and monetary sanctions under Regulation 55(4), suspension or revocation of designation under Regulation 55, and notification and publication of revocation under Regulation 55. So from my assessment, from the question and answers that I have posted before you, I realize there is a real gap, there is a serious gap between students analyzing various key concepts in the financial payment systems. It looks like people were introducing this unit in a general overview without going into the nitty-gritties. This is why I said we will have a separate webinar that is focusing so fully on financial payment system, where we are starting from the top going to the end, and this is a webinar that will be in form of slides where we will understand even the definition of basic key terms like designation, payment service provider, who are they, so that you appreciate exactly where we are coming from. So I had to test first your understanding through this kind of questions, and since no one has attempted any one of the question, automatically there is a serious gap in this unit. And if this topic is to be tested as a compulsory question, and particularly in designated systems, automatically students will have to fail that question. So hold on as I shift gears to